In today's video, we're diving deep into some shocking revelations regarding Citadel and AMC shares, the murky world of short selling, and how financial institutions have racked up over $600 billion in losses. What's going on behind the scenes, and what does this mean for retail investors like us? Let's get into it. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone, remember this is not a financial advice video. Let's start with Citadel Securities. I've been analyzing Citadel's data for August 2024, and things are looking even more suspicious than before. Throughout the month, Citadel handled millions of AMC shares, but here's the catch. Not a single one of those trades made it to public exchanges. That's right. Every single trade was internalized, kept within Citadel. This means no competition from other exchanges, no market transparency, and a monopoly over trading activities for AMC shares. They controlled every transaction, essentially manipulating the flow of the market. What does this mean for retail investors? With zero shares being routed outside of Citadel's own systems, the public markets are left in the dark. This setup allows Citadel to dictate the price, justify their practices, and ensure profits for themselves. They claim it's all about getting the best execution price, but the reality is far from it. We're seeing negative price improvements and prices worse than what we should be getting. This lack of competition can skew prices, and ultimately, retail investors like us are at a disadvantage. Citadel's hold over AMC shares doesn't just stop at controlling trades. As a market maker, they are the ones setting the prices for these shares, and they have a vested interest in keeping prices low. How? Citadel is over-leveraged on short positions for AMC. If the price drops, they benefit, plain and simple. It's a clear conflict of interest. They're managing the trades, controlling the prices, and betting on the stock's decline. Let's break this down further. Whenever you or I place a buy order for AMC, those orders aren't routed into the public exchange, which would normally push the price up. Instead, they get funneled into dark pools, hidden from the public eye, ensuring that the price remains stagnant or even drops. On the flip side, sell orders are processed in the open market, creating the illusion of a selling frenzy, which again drags the price down. This imbalance between buy and sell orders gives short sellers a huge advantage and allows them to manipulate the stock to their favor. Let's talk numbers. As of last week, the reported short interest for AMC stood at 51.2 million shares, or 15.2% of the float. But can we trust these numbers? Not really. We know that off-exchange shorting and synthetic shares aren't always reported. The true short interest could be much higher, possibly even 10, 50, or 100 times more than the reported figure. It's like an iceberg. What we see is just a tiny fraction of what's really happening below the surface. Adding to this mystery is the rising cost to borrow shares. Despite some shorts supposedly covering, borrowing costs have increased. This typically indicates higher demand for shorting or a limited supply of shares. But if some short positions were covered, shouldn't borrowing costs go down? The inconsistencies here suggest a much larger game is being played, one where market makers and short sellers are exploiting loopholes to manipulate the market. Why do they do it? Simple, to break retail investors. By driving the price down, they hope we'll lose faith, panic sell, and abandon AMC. But that's not what's happening. On the contrary, when AMC's price drops, many retail investors see it as an opportunity to buy more at a discount. This resilience is throwing short sellers off their game. They never anticipated that 3 years into this fight, retail investors would still be holding strong. When we buy AMC shares today, there's a good chance we're purchasing synthetic or fake shares. But here's the thing. When the shorts eventually have to cover, they'll have to buy back not only the legitimate shares, but also these synthetic ones. This is a ticking time bomb, making the situation extremely dangerous for short sellers. In South Korea, authorities are cracking down on illegal short selling with severe penalties, including life imprisonment. This is setting a new precedent that could eventually influence U.S. markets. Imagine a world where manipulative short sellers face the same legal consequences. It would transform the market, making it healthier and fairer for all participants. Just recently, a short seller in the U.S. was convicted of orchestrating a pump-and-dump scheme. This is just the beginning. With growing awareness and pushback from retail investors, regulators will have no choice but to enforce stricter laws against market manipulation. The problem doesn't end with AMC or other meme stocks. Let's zoom out to the bigger picture. The U.S. Treasury market. Failures to deliver FTDs at the DTCC have hit a staggering $5 trillion in 2024 alone. While this number represents Treasury settlements, the implications spill over into equities like AMC and GME. It shows a system-wide failure where synthetic shares and naked short selling are rampant, making it nearly impossible to settle trades properly. This isn't just a liquidity issue, it's a ticking time bomb that could shake the entire financial system. With $5 trillion in unresolved trades, the DTCC is sitting on a massive pile of risk that could explode at any moment, affecting every corner of the market. Now let's talk about the banks. As of October 2024, U.S. banks have reported over $600 billion in unrealized losses. This is a dramatic increase from just a year ago when the number stood at $88 billion. What happened? The Federal Reserve stopped disclosing the net unrealized gains for banks, likely to prevent panic. The truth is, banks are in trouble. Many of them are over-leveraged with trillions of dollars tied up in derivatives. These complex financial instruments are highly volatile, and any sudden market movement could push these losses from billions into trillions. Hedge funds that borrowed from these banks are also in deep trouble, facing margin calls as their short positions become untenable. The recent surge in the Hong Kong stock market, which jumped 6% following stimulus announcements from China, is causing major headaches for hedge funds. Many of them were actively shorting Chinese stocks, and the sudden rise has triggered margin calls. This is a significant development because these hedge funds are backed by U.S. banks. As the index climbs, the losses pile up, putting both the hedge funds and the banks that lent to them at risk. With the banks already reeling from $600 billion in losses, any further deterioration could have catastrophic effects. If these loans default, it won't just be hedge funds taking a hit. The entire financial system could be dragged down with them. The current landscape is bleak for retail investors, but the tide is slowly turning. Countries like South Korea are leading the way by enforcing stricter regulations. If other nations follow suit, we could see a global crackdown on illegal short selling. Until then, it's up to us to stay informed, remain vigilant, and continue the fight against those who seek to exploit the market for their gain. In the end, whether it's Citadel controlling AMC's trades, short sellers manipulating prices, or banks hiding massive losses, transparency and fairness are key. The more light we shine on these practices, the harder it becomes for bad actors to operate in the shadows. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.